Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Astera Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky.
Right.
VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so let's jump right into this. Because Astera Labs, we're seeing this staggering 32% climb in the stock price recently.
Yeah, it's been explosive.
And it's driven by this just unbelievable 93% year-over-year revenue jump. So our main objective for you listening at home today is figuring out if this explosive growth makes Astera Labs a durable multi-year wealth builder, or, if we're staring down a classic valuation trap.
Right, and to figure that out, before we even look at the chart, I want you to visualize the whole artificial intelligence boom as this giant, rapidly evolving biological system.
Okay, I like that.
Right. So almost all the attention and, well, capital is fixated on the brains of the operation. Those massive, hyper-expensive AI processors.
Yeah.
But today, we are focusing on the central nervous system.
The nervous. Okay, yeah, that makes sense because they're essentially solving this ultimate physics bottleneck in AI infrastructure, right?
Exactly. They fix a physics problem.
All right, let's move into the wealth building context, because how does solving a physics problem actually build wealth for your portfolio?
Well, you have to understand the physical reality of a massive data center. You've got these clusters of advanced processors, they're often called XPUs.
Right.
And they have to work together to train these massive AI models. But as the data moves faster and faster between these separate chips, the physical electrical signal actually degrades.
Wait, really? It just degrades?
Yeah, it literally loses integrity as it travels over the copper wires or the fiber optics. And, if the data gets corrupted, those massive, expensive processors are completely useless.
Oh, wow. So the processors are essentially outrunning the physical infrastructure they're plugged into.
Exactly. And that is where Astera Labs comes in. They provide the critical connectivity solutions that fix this. They use this new standard called PCIe 6, which is basically the next generation ultra-high-speed data highway inside these server racks. And they act as signal repeaters and smart fabric switches. So they clean up, they amplify, and they accelerate that data so the whole system functions perfectly.
Right, which, that fundamentally shifts how you should view this investment. Because instead of trying to pick which major tech giant is going to win the AI software war, this is an infrastructure play.
Yeah, it's the classic picks and shovels play.
Exactly, the gold miner analogy. But honestly, I think a better way to look at this is as a toll booth on the data highway. These tech giants are spending billions to build these massive computing cities, right? And Astera Labs owns the fundamental technology required to lay down the superhighways between those cities. So every single piece of data has to pay the toll.
That is precisely the right framework. Whoever wins the AI model war, they still have to pay the infrastructure toll to physically move the data.
But, as a cautious investor, I have to ask, hasn't the market already realized this? Like, if everybody knows this company owns the toll booth, isn't the price of admission already so high that it's just too dangerous for a risk-aware investor to buy in?
Well, to answer if the toll booth is too expensive, we have to open up the books.
Now let's look at the fundamentals.
Yeah, because the fundamentals tell a very compelling story here.
The numbers genuinely require a double take.
Yep.
For the first quarter of 2026, they reported record revenue of $308.4 million.
Which is huge.
Right. Just to provide some scale, that's a 14% sequential increase from the previous quarter. But it represents that massive 93% year-over-year growth we mentioned earlier.
Right.
When a hardware-centric company nearly doubles its revenue in 12 months, that is not normal organic growth. That's a sign of desperate structural market demand. And they just cleanly beat the consensus estimates on Wall Street, which were sitting at $292.19 million.
And importantly, that revenue flowed straight down to the bottom line.
Yeah.
Non-GAAP earnings per share hit $61.61. Yeah, which completely crushed the street estimate of $7.54. And when you look inside that revenue, the growth is extremely broad-based. Their PCIe 6 business alone has rapidly expanded to make up over 1/3 of their total revenue.
So it's not just a future concept.
Exactly. It proves that the rapid adoption of these next-generation interconnects is happening right now. It's showing up in cold, hard cash on the balance sheet.
But, okay, what really stopped me in my tracks was the guidance they provided, and specifically their margins. They are guiding for the second quarter of 2026 to accelerate even further. They're pointing to a revenue range between $355 million and $365 million.
Yeah.
But let's talk about profitability, because this is crazy. They reported a GAAP gross margin of 76.3% and an operating margin of 20.1%. Just to translate that for you listening, a 76% gross margin in a business that manufactures physical hardware is almost unheard of.
It really is.
That is the kind of margin you normally only see in pure software companies.
It's a profound demonstration of pricing power. I mean, they are charging a massive premium because their technology is completely mission critical. And that cash flow translates to a true fortress balance sheet. They are sitting on $1.19 billion in cash and equivalents right now, and they carry absolutely zero debt.
Zero debt. That's amazing. But I do need to jump in and clarify one thing that might spook some people if they're glancing through the recent financial filings. They recently filed a $2.05 billion shelf registration.
Right. Yeah, we should cover that.
For those who don't know, a shelf registration allows a company to issue new stock. Usually, when a company files for $2 billion in new shares, investors panic because it means massive shareholder dilution or that the company is desperate for cash to pay off debt. But that isn't the case here, right?
Right, not at all. Given their zero debt status and that massive cash pile, they aren't desperate for funding. This specific shelf registration is tied to an employee stock ownership plan.
Oh.
Yeah, it's a strategic tool for retaining top engineering talent in a hyper-competitive industry. It's definitely not a red flag signaling financial distress.
Okay, fair enough. But here's where I have to heavily push back on the bullish narrative. I look at that incredible 76% gross margin, and I don't just see profitability. I see a massive target painted on their back.
Okay, how so?
Well, at the end of the day, they are selling physical connectivity hardware. What is to stop massive semiconductor giants like Broadcom or Marvell from looking at those juicy margins, flexing their huge manufacturing scale, and just flooding the market with cheaper alternatives? I mean, how on earth do you maintain software-like margins in a hardware business?
That is the exact right question to ask. And it brings us to what makes this business truly special. They have what they call silicon-to-systems integration.
Silicon-to-systems.
Right. Astera Labs is not just selling you a physical chip or a switch. They have a highly proprietary software suite called Cosmos, and this software integrates deeply into the cloud provider's own operating systems.
Oh, I see. So it isn't just plug-and-play hardware where you can easily swap one brand for another.
Not at all. The Cosmos suite provides critical diagnostics, fleet management, and real-time telemetry data that actually improves the overall performance and uptime of the entire AI data center.
Wow.
Yeah, so once a massive cloud provider integrates that software into the very fabric of their architecture, the switching costs to rip it out and replace it with a slightly cheaper competitor's hardware become astronomically high. The operational risk of downtime is just too great. You are locked into their ecosystem.
All right.
Furthermore, Astera is a founding promoter of the UA-Link consortium.
Let's translate that acronym because that's super important. NVIDIA currently dominates the AI space, right? And they have a proprietary connection technology called NVLink. If you use NVLink, you are effectively locked into NVIDIA's walled garden. UA-Link is an alliance of other massive tech giants trying to break that monopoly by creating a universal open standard for connectivity. So Astera positioning themselves at the foundation of that open standard, it makes them the essential neutral arms dealer in this massive infrastructure war.
That's spot on. So knowing they have this impenetrable financial fortress and a deep software moat, that brings us to the catalyst timeline.
Right, because holding a great company doesn't mean much if there are no catalysts on the horizon to attract new buyers. So what are the specific milestones we should be watching over the next 3 to 6 months?
Well, the first most immediate hurdle is the upcoming earnings report. We're looking at the Q2 2026 report dropping in late July or early August.
Okay.
Given that blistering 93% growth trajectory and the internal guidance pushing toward that $365 million mark, another beat and raise quarter is highly probable. The market will be aggressively looking to see if they can maintain that momentum.
But earnings are basically a backward-looking metric, right? The real fundamental catalyst, the thing that dramatically expands their future earning potential, is their upcoming product ramp.
Precisely. The critical event to watch in the second half of 2026 is the full production rollout of their Scorpio X series.
Scorpio X series.
Yeah, this is a 320-lane smart fabric switch. To put the scale of this launch in perspective, this single product line targets a merchant switch market that analysts project will reach $20 billion by the year 2030.
$20 billion.
Yeah. If Astera executes this production ramp smoothly, without any major supply chain bottlenecks, it fundamentally redefines their total addressable market.
That's massive. And beyond their specific products, we also have to factor in the broader macroeconomic catalysts. Like NVIDIA's recent Q1 results were essentially a giant green light for the entire tech sector. It confirmed that artificial intelligence capital expenditure is actually accelerating. The massive hyperscalers are not slowing down their infrastructure spending at all. But, alongside those tangible business catalysts, I've also seen the speculative rumor mill working overtime.
Oh, the S&P rumor.
Yeah. There is a lot of chatter suggesting that because Astera Labs is now stabilizing above a $50 billion market capitalization, it's become a prime candidate for inclusion in the S&P 500 index.
Which is a massive structural catalyst. If a company gets added to the S&P 500, every single passive index fund and ETF that tracks that benchmark is legally forced to go out into the open market and buy shares of the stock, completely regardless of the price. It creates a tsunami of automatic buying pressure.
I do have to wave a massive caution flag for you here, though.
Yes.
Buying any stock purely based on the hope of index inclusion is an incredibly dangerous speculative game. I've seen retail investors get absolutely crushed trying to front-run those announcements. You just cannot build a solid wealth-building strategy around a rumor.
I agree completely. You absolutely do not buy it for the rumor. S&P 500 inclusion should only be viewed as a potential cherry on top of an already solid thesis. Your focus as an investor must remain entirely on the tangible operational catalysts.
Right.
Like whether that Scorpio X series ramp can successfully penetrate that $20 billion market. That is the actual engine of long-term value.
Okay, so with all these massive fundamental growth engines firing and a clear timeline of catalysts ahead, how is the smart money actually trading this right now? Now let's pivot to the chart.
The technical posture right now is the definition of a high momentum breakout. The stock recently staged a massive gap up to $306.88.
Wow.
And that places it right on the doorstep of its all-time 52-week high of $315.81.
Which is just a breathtaking ascent when you zoom out and realize its 52-week low was sitting all the way down at $84.78.
Yeah, it represents a total structural regime change in how the market values the company. It's currently trading miles above its key technical baselines. For context, the 50-day moving average is all the way down at $174.13, and the 200-day moving average is way down at $160.46.
Right.
When you have a stock that gaps up and stubbornly holds price levels that far above its long-term moving averages, it really confirms a deeply entrenched, highly aggressive uptrend.
The raw momentum numbers are wild. I mean, we are looking at a 42.35% return in just a 7-day period and a total return of 224.33% over the past year.
It's incredible.
That kind of sustained, relentless buying pressure does not happen just because retail day traders are excited. That volume signifies massive, sustained institutional accumulation. The heavy-hitting funds are aggressively building their long-term positions.
Definitely.
And anyone who follows the markets knew a but was coming. Here I'm looking at the beta on this stock, and it sits at an extreme 3.35. We really need to translate what that actually means for your portfolio risk.
It is exceptionally high, and it fundamentally changes how you have to handle the stock.
Exactly. A beta of 1.0 means the stock moves exactly in sync with the broader market. A beta of 3.35 means it has triple the volatility. So historically, if the S&P 500 drops 1%, this stock could violently swing down over 3%.
Right.
Now, during a massive AI rally, that high beta acts like a jet engine, aggressively amplifying your upside. But you must be prepared because if the broader tech sector experiences a sudden macroeconomic downturn, a stock with a 3.35 beta will mercilessly punish buyers who are caught off guard. That kind of volatility is a severe double-edged sword.
which makes gauging the underlying market psychology absolutely crucial. When a stock is that volatile, you have to understand the sentiment of the major players navigating those swings.
So what does market sentiment look like right now?
Well, the sentiment landscape right now is fascinating because there is a severe duality among the professional analysts. The overarching mood is deeply bullish, but there is an intense friction regarding the valuation.
Okay, friction how?
So you have major institutions like Citigroup raising their price target to $245.
Yeah.
Jefferies reiterated a target of $270. And Evercore is incredibly aggressive, setting a target all the way up at $297.
But then you look at Northland, they actually downgraded the stock to a market perform rating and completely removed their previous $225 price target.
Right, but what is crucial for you to understand is why Northland downgraded it. They didn't point to any fundamental deterioration in the actual business model. They explicitly cited stretched valuation multiples.
So it is an argument about the price tag being too high, not the product being flawed.
Exactly. Meanwhile, you have broader macroeconomic tailwinds heavily supporting the sentiment for these high-beta semiconductor names. For instance, we're seeing market-wide rallies driven by geopolitical de-escalation, specifically the recent progress regarding peace talks with Iran.
Right.
When global macroeconomic fear decreases, institutional capital flows aggressively back into risk-on high-growth assets like Astera.
You also have to look directly at the actions of the people running the company, though. Insider ownership sits at a very healthy 12.5%. And having executives own that much of the company heavily aligns the interests of management with the interests of long-term retail shareholders.
Right, absolutely.
However, the recent SEC filings clearly show that insiders have been actively selling off shares. And I am going to jump on that point immediately because it's a massive red flag for a lot of people.
Yeah, always is.
If this company really is the indispensable nervous system for the future of artificial intelligence, and they're about to capture a $20 billion market with their new switch, why on earth are the insiders cashing out their chips right now?
It is the most logical question to ask when you see those filings. But, you have to remove the emotion and look at the context of that 224% one-year run-up.
Okay.
If you're an executive and your personal net worth is literally tripled in 12 months because your company's stock exploded, basic prudent wealth management dictates that you take some chips off the table to diversify your life.
Right, yeah. You don't want your children's college fund and your entire retirement entirely tied to a single hyper-volatile asset with a beta of 3.35.
Exactly. What the filings show is standard portfolio rebalancing from executives. We are absolutely not seeing what the industry calls cluster selling.
Cluster selling.
Right, which is when multiple key insiders all rush for the exit door simultaneously in a panic because they secretly know the underlying business is failing.
Right.
There is no evidence of that here. The foundational business is stronger than ever.
But just because the business is fundamentally strong doesn't mean the investment is completely safe. That stretched valuation Northland pointed out brings us straight into the most critical part of this analysis. Now let's talk about the risks.
Okay.
Because extreme bullish sentiment and sky-high valuations create a market environment that is priced for absolute perfection. And when a stock is priced for perfection, it introduces very severe vulnerabilities to your capital.
The valuation is undoubtedly the loudest and most valid bear case. The stock is currently trading at a blistering price-to-earnings ratio of 207.35 and a PEG ratio of 4.06.
Let's make sure we ground those numbers because that's wild. A normal, healthy tech stock might trade at a PE ratio of 25 or 30. At a PE of 207, you are paying $207 for every single dollar of current earnings.
Yeah, it's steep.
You aren't just paying for future growth, you are paying for absolute flawless execution. If they delay a product launch by even a month or miss an earnings target by a penny, a stock with that multiple can fall off a cliff. And the PEG ratio, the price to earnings to growth ratio, that tries to balance that high price against their rapid growth rate. But at 4.06, it still screams that the stock is highly expensive.
It leaves zero room for error. And the specific error Wall Street is worried about right now is margin compression. Analysts are currently modeling a 200 to 300 basis point decline in gross margins in the second half of 2026.
Meaning a drop of 2 to 3% in their overall profit margin. Why is that drop expected?
It's due to an unfavorable mix shift. As they successfully launch the new Scorpio switches, a much larger percentage of their total sales will come from that heavy physical hardware. And that naturally carries a slightly lower percentage margin than their other established product lines.
And Wall Street is notoriously ruthless about margin decay. They will aggressively plenish high multiple tech stocks at the very first sign that profitability is slipping.
It's a valid fear, But if you look closer at the mechanics of that margin compression, it isn't actually a negative for the business.
Yeah.
Yes, the gross margin percentage might dip by a few hundred basis points, but that dip is the natural byproduct of a massively successful high-volume hardware product ramp.
Right.
Because they will be selling exponentially more physical units at scale, the absolute dollar margins, the actual river of cash piling up in their bank accounts will explode. Furthermore, as millions of those new hardware units get installed into data centers, that highly profitable Cosmos software gets attached to them.
I see.
Over time, the recurring revenue from those software attach rates will eventually pull the overall percentage margins right back up.
That makes a lot of sense. The sheer volume of cash flow grows massively, even if the percentage shrinks temporarily during the rollout phase. There is one more major risk we have to put on the table, though, and that is customer concentration.
Yeah, definitely.
A huge portion of their massive revenue is driven by just a handful of massive hyperscalers, the big cloud providers. Northland issued a stark warning about this. They noted that these hyperscalers have recently taken on roughly $260 billion in combined debt to fund this desperate AI arms race. So Northland is warning that we could see a severe decline in overall data center spending by 2027 as these tech giants become weighed down by that debt burden and are basically forced to pause their building.
That is the ultimate doomsday scenario for any infrastructure play. If the builders stop building, the toll booth sits empty. But the counter-argument is that hyperscaler AI spending right now is an existential arms race. For a company like Microsoft or Google, reducing compute investment right now equates to voluntarily surrendering the future of the technology sector to their rivals.
Yeah, they can't afford to do that.
Exactly. They will likely cut operational costs everywhere else in their businesses before they ever stop building advanced AI data centers. Additionally, Astera is actively mitigating this risk by diversifying. They are intentionally capturing new custom design wins for entirely different applications, purposely spreading out their customer base so they aren't completely reliant on just 3 or 4 massive buyers.
So with everything on the table, what's the final verdict? I mean, weighing that massive structural advantage and incredible growth against the undeniable valuation risks and extreme volatility, what is the conclusion for an investor trying to navigate this?
Based on the research, this gets a bullish score of 8 out of 10.
That is a very confident rating given the 207 PE ratio.
It is confident, but it comes with a strict condition, which is your time horizon. The long-term view here is that this is a multi-year investment. If you are just trying to trade the next 3 weeks of price action, that extreme 3.35 beta is going to violently shake you out of your position.
Yeah, absolutely.
The true fundamental inflection point for the Scorpio X series and their next generation optical interconnects is not going to fully hit the balance sheet until late 2026 and into 2027.
So the core takeaway is that you must be willing to endure severe, stomach-churning, short-term valuation volatility in exchange for holding a durable, incredibly high-margin competitive moat in the most important sector of the economy.
Precisely.
You are paying a premium price today to guarantee you own the toll booth on the data highway of tomorrow. It forces you to wonder in an arms race where the software weapons are constantly changing and evolving, is owning the battlefield itself the only true way to guarantee a victory? And if you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you on the next Smart Wealth with Joshua episode.